Hi, and thanks for joining us at our team at Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown. How are you doing, Katie?
Hello, I'm doing very well. How are you?
Good, good. So for a better part of a year, we've been doing these market updates to help you stay atop of the conversation that are happening around markets and investing as we really experience one of the more turbulent times in any of our investing experience. But Katie and I have been talking a lot recently about how 2021 is going to be a year where a lot of families are revisiting every aspect of their wealth picture. So we see these, what we're going to call intentional wealth updates, as a chance for you to hear our perspective on what's happening regarding policy changes, tax laws, every aspect of investing, taxes, and estate. We found that for most families, developing an intentional financial plan builds their confidence and helps them to navigate all of the decisions that come ahead of them. So these updates are going to serve as a means for us to communicate what we're learning and experiencing and sharing that out with our community. Katie, what do you see as the opportunity here to talk really about financial planning as just the unifying concept behind the work that we do?
Yeah, I think, we're always careful not to have too much of a narrow scope within our business of just the investment piece of it, because the investment piece, is the tool to help support everything else. And so our goal is to really be well-versed and strategic across the entire wealth management realm to be hopefully providing some insights and some information that may help the viewers think about things a little bit differently, or start to think about maybe some strategies that they hadn't thought of before when taking into account all of the pieces of their financial picture. That's the part of the business, that we love, and we do feel as if sometimes it doesn't get enough attention. So
Right.
we're here to bring it to you.
Great. And a lot of when we talk about making planning decisions, we always have to draw the line between the environment that a decision made sense several years ago is not necessarily the environment we're in right now. And we found an article today we're going to pull forward and talk about from the Journal of Financial Planning. And it's about what should be your expectations for home prices and the value of a home as a financial investment for you. We've seen what's happening in the housing market nationwide. The trends have been very positive of late. That hasn't always been the case. And we want to be careful about modeling, maybe if you're a millennial and think about how your parents experienced, home appreciation, that may not be the case. Katie, tell me a little bit about what you found in this article in the Journal of Financial Planning.
Yeah, it was really fascinating because it did talk about how the housing market had a 100-year history of really just keeping pace with inflation, kind of 100 years ending at 1998, where yes, there was growth within the homes, but it wasn't really considered as much of an investment or an asset beyond, this is what I need for my lifestyle and living. And it served that purpose, not necessarily adding to the growth of somebody's financial picture. But then 1998, we started to see kind of a sharp incline. And there are a few different factors that led to that. Do you want to kick off some of those factors? It was interesting.
Sure. There were three conditions that kind of converged at the same time. They took some time to develop,
Yes.
but we talk about low interest rates. Many of our clients will remember times in the early 80s where mortgage rates were in the 16, 17% range and just went on a rapid decline over the course of a couple of decades. You had easing credit standards, so you no longer had to put up 20 or 30% of a down payment. You could get by with much less than that, and that made home availability more accessible and drove up prices. But the third thing was called a demographic or professional development, which was dual income families. And what began to accelerate as a trend in the 60s, 70s, and 80s suddenly became the norm. And dual income households suddenly, the purchasing power of that household grew geometrically instead of incrementally. And then put all of those together, and the bull market and wealth effect of the 90s, and kaboom! And suddenly you had the explosion into the 2000s. But that's not necessarily where we are right now, is it?
No, but let's take a quick look at this chart because it's really fascinating to see. Yeah, as we talked about for nearly 100 years, the real housing values over time did not increase to a great degree. But then we see these spikes here, and obviously this is the financial crisis that occurred. But then the recovery and kind of that trend up, and obviously the trend that we're experiencing right now. And you're right, each of those pieces contributed quite a bit individually, but then bringing them together at the same time So if your interest rate is lower, then you can borrow more money, have lower monthly payments. So that means you can buy more of a house. So one of the examples from the article was if you have $100,000 to put down on a home and you were to get a mortgage and your mortgage rate is 4.5%, then you might be able to purchase a $500,000 home. Whereas if it's 3.5%, you're bumping up closer to $600,000 if you're trying to keep your monthly payment around $200 or $2,000 per month. And so that 1% difference can make up, $50,000, $75,000 or so more in the home purchase price.
I think one of the interesting things on that chart that I hadn't noticed before is that big spike up that happened at the end of World War II. So suddenly you had a giant demand spike that came in and spiked up toward the end of the 1940s. And then everything pretty much leveled off. So for almost 35 years, between 1945 or 50 and 1980, there's really no movement in prices. So if you didn't capture that beginning part, that's where that experience, and then things bumped up from there. So one of the questions the article raised was, then how should you think about your home as a financial asset, as a useful financial asset? And the author talks about a conversation where someone's thinking about using their home as a vehicle for retirement. As in, I'm not going to fund my 401k as much. My house is going to be part of my retirement. Poke some holes in that based on your experience.
One, the housing market, if you're going to use your personal residence in that way, then you're setting yourself up and kind of making the decision now, I'm going to revamp my entire life. I'm going to have to sell, or I'm going to have to figure out a way to get equity out of that home. So you're adding a transition on top of another transition that's already there. So that's just kind of the personal life aspect of it. But then timing is everything, and we've seen that just in the past year. It took a while after the financial crisis, 2008, 2009, for those home values to kind of even just get back to break even. And heaven forbid something happens around that time. You don't want to be pigeonholed into having to sell at a particular year, particular time. We've heard similar things too, where people have strategies to use different, like rental homes, for instance, with the thought of, well, I'll sell that one when my child goes off to college, or I'll, sell it at this point to fund something else. And that's really difficult to time because it's a liquidity issue. You might be able to sell it where you want to, but you may not be able to either.
Right. And also there's this idea of, and we're big on liquidity. Whenever we talk about planning, like, do you have access to it? Great that it's there. Do you have access to it?
Yes.
But also there's concentration. I mean, my house is in this state, in this zip code, in this neighborhood. And however things ebb and flow for that particular state, zip code, neighborhood, so it goes, that's what I get. And you kind of can't parlay, one booming neighborhood versus another if you're just concentrated in that one spot. So you have that risk. And then there's carrying costs. People always underestimate. We kind of write off the idea of how much I'm paying in taxes, maintenance, what that new roof is going to cost 10 years or 5 years before I retire. So suddenly that's an extra cost. Understated, right?
Yes. Yes, I would agree with that.
We've seen people successfully use houses, home equity for college savings, it's been a component of retirement. But I think right now, when we talk about managing expectations, that's really a huge thing for everyone right now. Saying, what am I expecting of this asset? What purpose does it serve? And in the case of a house, that purpose, that's the shelter over your head, but expecting it to perform like a diversified asset with cash flow and everything else, it's just not quite there, is it?
And you touch on something there a little bit too, Dennis, as far as using a home. There's a difference between whether it's your personal residence or it's an investment property. And you might have both, but you might want to view them differently, in that your home, you may be willing to pay more for your home, or there's a quality of life premium that you may be willing to put into it. And the carrying costs and everything else, that's okay. You're accepting kind of a trade-off there. But if you're buying a piece of property strictly for investment purposes, I think there's a different level of scrutiny that should be applied to how much risk you're taking, how much of a return you're expecting. And I would argue you should expect if you want to use it as an investment, then you want to make sure that everything is aligning so that the returns on it in theory, should be greater than the returns that you would get within a traditional investment portfolio, because you can't change it to cash. You can't get that liquidity, and you can't always predict all the carrying costs are going to go along with it.
You just brought up something really interesting that I hadn't thought too much about when it comes to housing. There's this behavioral economics term called the sunk cost fallacy, which means if you've put money in something, the thing that you bought, the thing that you own, you are going to assign a higher value to than anyone else will. Yes. We all know this. Like the house that I own, of course, is worth more than what you think it is, but that's it's an emotional thing. And it's one of the reasons why I love index fund and passive investing, because I don't love them. I don't fall in love with an index of 500 stocks. There's no emotion to it for me at all. Whereas you can see where somebody might fall in love with a company or a house or a locale or something like that. Be careful of banking a lot on something that has an emotional component, like the place where you raised your kids. So these are the types of conversations that we're going to be having especially between now and the end of the year, as we help you to navigate a dynamic and changing financial planning environment. Again, the topics of investing, taxation, estate, risk, all of those come into the fold. So if there's a particular topic you'd like to hear us talk more about, shoot us a note. We're always happy to hear from you. In the meantime, we will catch up with you soon.